Everyone wants to build wealth. It's the key to financial freedom. It lets you stop worrying about money. You can finally do what you want to do. But most people think you need a lot of money to start. They think you need a lucky break or a huge inheritance. That's just not true. The real secret is starting, even if it's with a small amount. That first $1,000 is more powerful than you can imagine. It's not just $1,000. It is a seed you are planting for your future financial success. It's the first step on a very long but very rewarding journey. The reason that first $1,000 is so important is because of something called compound interest. Albert Einstein supposedly called it the eighth wonder of the world. Here's how it works. You invest your money, it earns a return, and that return starts earning its own return. It's like a snowball rolling downhill. Time is your single greatest asset when it comes to investing. If you hide that $1,000 under your mattress, in 20 or 30 years, it will still be $1,000. Because of inflation, it will actually be worth a lot less. But if you invest it, that money goes to work. Let's break down how you can put that first $1,000 to work for you. Let's start with the safest and, for most people, the best option for long-term growth. This is the low-risk approach. If you are nervous about investing, or just want to set it and forget it, this is for you. The perfect vehicle for this strategy is a broad market index fund, like an S&P 500 ETF. An ETF is an exchange-traded fund. It's a basket of stocks. You can buy and sell it just like a single stock. When you buy a share of an S&P 500 ETF, you are not just buying one company. You are buying a tiny piece of the 500 largest companies in the United States. Think of it as instant diversification. Instead of betting all your money on one horse, you bet a tiny amount on 500 horses at once. This spreads out your risk significantly. If one company does poorly, it has very small impact on your overall investment. Historically, the S&P 500 has returned an average of about 10% per year over the long run. This isn't a guarantee, of course, but it shows the power of investing in the market as a whole. The pros of this approach are very clear. It is incredibly low cost. Fees are almost nothing. It's passive. Buy and hold. The main con? You will never beat the market. You match it minus tiny fees. You won't get those explosive 1,000% wins from a single hot stock. Market goes down sometimes. The key is not to panic and sell. Hold on, keep investing if you can, and wait for recovery. If you're comfortable with a little more risk and want to be slightly more hands-on, move into moderate risk. This is the moderate risk category. Think blue-chip dividend stocks or dividend ETFs. Blue-chip stocks are shares in large, well-established, financially sound companies that have operated for many years. Think household names, industry leaders that aren't going anywhere. What makes them special is the dividend, a portion of profits paid to shareholders. It's like a thank you gift for owning their stock. You get price appreciation and regular income, usually quarterly. Reinvest dividends to buy more shares, which then generate more dividends. This creates a powerful compounding effect boosting total returns. You get two ways to make money: growth and regular income. Dividends can provide a cushion when markets are flat or down. Owning shares in companies you know gives a connection to your investments. You have more control than an index fund. Less risky than startups, but requires more work. You are no longer as diversified as with an S&P 500 index fund. A single troubled company can disproportionately hurt your portfolio. You have to do research, financial health, dividend history, future prospects. A dividend is never guaranteed. Companies can cut it in hard times. Consider blue chips as part of a balanced portfolio. They can be a stable income-generating complement to core holdings. Next, the high-risk, high-reward path. Exciting but dangerous. Now we enter the high-risk, high-reward territory. This is, honestly, the most exciting and also the most dangerous way to invest your $1,000. We're talking about picking individual stocks, often smaller, high-growth companies. Companies you believe could be the next big thing. Think AI, biotechnology, renewable energy. Get in early. If you pick the right one, returns can be astronomical. That $1,000 could turn into $10,000 or more. Stories of small investors becoming millionaires are tempting. If your research and timing are perfect, you can beat the market. A winner can outperform what index funds deliver. This is active investing. You are the pilot. It takes skill and exhaustive research, and honestly, a little bit of luck. The pros are all about that upside, but the cons are huge. Many more companies fail than succeed. These stocks can be wildly volatile. Prices swing on news and sentiment. Even professional managers struggle to consistently beat the market. For a beginner with $1,000, putting it all on one or two high-risk stocks is more like gambling than investing. The risk of losing your entire investment is real. It can be an expensive lesson to learn. Now let's look at how to choose the path that fits you. So we've looked at 3 different paths for your first $1,000. The low-risk path with a broad market index fund, the moderate risk path with blue-chip dividend stocks, and the high-risk path with individual growth stocks. There is no single best option that fits everyone. The right choice depends on your situation, your goals, and your comfort with risk. The worst thing is an investment that keeps you up at night. If you like set and forget, an S&P 500 index fund is a fantastic choice. If you enjoy research but want stability, consider blue-chip dividend stocks or a dividend ETF. If you tolerate high risk and accept the chance of losing it all, a carefully selected growth stock could be your path. You can also mix, perhaps $800 into an index fund for core exposure, and use $200 to experiment with a dividend or growth stock. Build a stable foundation while satisfying curiosity. Start now. Today is the perfect day to begin. Your future self will thank you for taking this step. Open a brokerage account and invest that $1,000. It doesn't matter if you start small. What matters is that you start. Your journey to financial freedom begins with that single step. Make it today. Remember, compound interest needs time to work its magic. Pick the strategy that fits you. Low, moderate, or high risk. Start now. Your future self will thank you. Please like and subscribe. It will help us grow and reach more people.